Mr. Dinanath Dubhashi, the Managing Director and CEO at L&T Finance Holdings, is joining us now. Hi, Dinanath. Thank you so much for making time and speaking with us. Well, your retail book growth is 35%, but the wholesale book has seen a rundown by 54%. How do you see the AUM mix shaping up in FY24, and what's the overall outlook for AUM growth?
I'm very happy to say that this quarter, fantastic quarter 23, FY23 has been a great year where we have shown very, very good numbers on everything. I mean, headline numbers, PAT number 1623, up around 52% from last year. One of the very important components of that is the retail growth. So retail from last year, around 45,000 crores has grown to about 61,000 crores. And this growth has come across segments. We are in 4 segments. One is in rural businesses, which is rural business finance. Second is in farmer finance. These 2 are rural businesses. And 2 are urban businesses, which is urban individuals, which has two-wheelers, which has housing loans, and which has consumer loans. And then our newest business, which is urban businesses, which is SME. Across businesses, I don't want to get into all the numbers. Across businesses, fantastic growth has been seen, which has led to total book growth of close to 35%. As I said, retail actually in the beginning of the year estimated that we will be around 65-66% retail. Instead of that, we have become 75% retail. And if you ask me for guidance for 24, which I normally don't give, but our target for 26, FY26 was greater than 80%. We are quite confident that we will cross even 90%.
Right. Thank you so much for taking time out and joining us. Mr. Dubhashi, your rural finance constitutes a major portion of your AUM, and there are those customers who have taken a hit. They've been impacted by the interest rate hikes, I'd imagine. So in context of this, what is the outlook on the traction that we can see for your disbursements for FY24?
I think across retail products, again, it is quite healthy for FY24. So if we take actually product by product, right? I mean, each of our products has grown very, very well. Let us take rural. Rural, more than interest rates, it is always affected by the sentiments. Yes, there are some news about El Nino and, various conflicting news there. But it is too early to talk about El Nino. It is even too early to talk about how the monsoon will be. Also, India, there is no good monsoon or bad monsoon. It also depends on what is the time distribution of monsoon, what is the geographical distribution of monsoon. Important things are to see what is in our control. So what is in the control of the farmer? That reservoir levels are very good compared to last year. So irrigation levels are very good. Crops and the yields have been very good. Prices have been very good, right? The other side of inflation is that food prices are good. So farmers always benefit. And all the welfare measures taken by the government are generally improved the rural sentiments. If you see some of the results, some of the FMCG results that have come already, you will see the management of FMCG talking about improving rural sentiment. So that is what will work much more for rural growth than, I would believe, interest rates.
Okay, and the loan growth as well seems to be faster than the growth that we have seen in the net interest income. What are the factors which is impacting this, and what kind of growth run rate should we expect for the net interest income going forward?
Okay. See, overall, in a time when the company is increasing one part of the book tremendously and reducing other part, overall NIIs, etc., don't have any meaning. Let us look at retail NIIs. So retail NIIs are actually at all-time high. They have actually increased in Q4. Q4, we are at around NII plus fees, we are at around 11.8% in retail. I'm not saying they will continue to increase. They will, in fact, definitely moderate. In fact, even last quarter, I have given the guidance that they will moderate, but my treasury as well as business did wonderfully well. Now, let us see what are the things which are working in favor. As I said, interest costs are close to peaking, no doubt. But some of the still, many of my lenders have to pass on the rate fully. So our cost of interest cost will definitely go up. But the way we have managed our ALMs, this increase has been a fraction of the total increase in interest rates. I mean, total, repo rate increase has been about 250 basis points. Our increase has been a fraction of that. So one, that is the point. Second, also the increasing percentage of retail in the overall book. So even though NII is reduced from say the current level of around 11.5, as I have already always said, reducing OPEX or reducing credit costs will compensate for that. And we are quite confident of achieving a pre-tax ROA of 4% in retail, which translates to a post-tax ROA of around 3%.
Provisions as well have fallen sharply sequentially. Is this because of the large amount that you've provided for in Q3? How comfortable are you with respect to asset quality?
Okay, no. The large amount which was provided in Q3, first of all, was a one-time mark-to-market provisions for the wholesale one. Again, as I would said, if I talk about my retail, my net stage 3, which is considered to be the most important parameter of credit quality, is at 0.71%, which is really one of the best in the industry, especially for a company which is in rural India. We expect that to remain rock solid around that level, perhaps slight improvement as we go ahead. But 0.71 is already a great number. We don't see any big concerns coming in asset quality and the provision ratios that we have. Our retail book is provided almost 80%. In addition to that, we are carrying macroprudential and other overlays of close to 1,200 crores. So we are very, very well provided, strong balance sheet, strong asset quality, all working well.
Okay, wanted to get a sense on the borrowing costs as well, because on an annual basis, they have come off. But if you look at from Q1 to Q3, the borrowing costs have been inching higher. What about the outlook going forward with respect to the borrowing cost?
See, first of all, we have to see that what is the expectation of RBI repo cost increase. There are various expectations, and it will depend on how the Fed acts or how inflation goes. But if you generally see, most economists don't expect a big increase in interest rate. In fact, most of them expect a pause now. And if inflation remains well in control, perhaps towards the end of the financial year, start reducing. So I would believe we are, if not at the end of the upcycle, near the close of the upcycle. However, costs of NBFCs may increase a little bit from now on, because the way the ALM is managed is we borrow fixed for a long time, and because of that, the increase has also not been as much as the repo cost. I would believe that cost of funds may go up by 25 to 30 basis points over the next quarter, takes 2 quarters. We are well in the position of absorbing it and not letting the overall profitability get affected.
All right, Mr. Dubhashi, thank you for taking time out and joining in and giving us a view on the quarterly earnings. Just to